Earring a blue Chicago Cubs pullover and sunglasses to avoid the rushing wind and glare of the road, money manager Joseph Fath spins his 1957 red and white Corvette around a corner. "Wait until we get this baby out onto the highway," he says. As the convertible's engine roars, a passing trucker honks his approval. Fath collects and restores cars from the 1950s and 60s. The most important car in his garage, though, is something new, an R1T pickup truck from Rivian, the electric vehicle outfit. Rivian has been one of Fath's biggest scores as manager of the T. Rowe Price Growth Stock Fund. In a short span of 2 years, the fund has more than quintupled a $928 million stake in Rivian to $4.8 billion by the end of 2021. Fath, 50, has run the $62 billion growth fund for 8 years. It's a demanding job. A few wrong bets would put at risk what Forbes estimates to be around $350 million a year in management fees that Baltimore's T. Rowe Price draws from this one fund, which accounts for about half of the growth stock strategy's assets under management. Thomas Rowe Price Jr., a pioneer of growth stock investing, created the mutual fund in 1950, when the fund business was in its infancy. Sticking to Price's vision of buying into the companies of the future, the fund seeks growth companies in industries undergoing what Fath, repeating a familiar theme on Wall Street, describes as disruptive change. For the fund's founder, the companies of the future included IBM and National Cash R. For Fath, it means companies like Amazon, Microsoft, Google parent Alphabet and Rivian. "We identify companies that can really be on the right side of change, ideally catching them at the early part of their growth," he says. Companies on the wrong side are not just retail stores and automakers. A conspicuous place of disruption is the industry in which Fath works, money management. Active management, which has experts picking stocks, is losing ground to passive management, in which stocks are bought mechanically from a list of all those available in a certain category. T. Rowe Price's strong suit has always been active management, and it now finds its handsome profit margin imperiled by vendors of index funds. For 6 years running, reports Morningstar, the firm has experienced a net outflow of assets. The ominous trend is visible at Fath's fund, which saw $5.8 billion walk out the door in 2020. The pace of departures picked up to $3.7 billion in the first half of last year.